What if I told you that some of the big names on the Wall Street that once dismissed Bitcoin as speculative bubble are now pouring billions into it? Yes, the very institution that call Bitcoin a fad are quietly accumulating crypto assets, and the trend is accelerating fast. So what is behind this shift from skepticism to strategic investment? And does it mean you should rethink your own portfolio? For years, crypto has been labeled as a risky bet, a playground for speculators, tech enthusiasts, and meme coin gamblers. But behind the scene, institutional investors, the big players like hedge funds, asset managers, and even pension funds have been steadily increasing their exposure to crypto assets. One clear sign: the explosive demand for Bitcoin ETF exchange traded fund. Since the launch of Bitcoin Spot ETF in January 2024, the number of institutional holders has skyrocketed, making Bitcoin more accessible to traditional investors than ever before. So why the change of heart? It is not just FOMO. Institutions are realizing that adding crypto to a diversified portfolio can actually improve return and reduce overall risk. How? Because crypto has a low correlation with traditional assets like stock and bonds. For example, Bitcoin price movements are largely independent of the S&P 500 or bond market. This means when stock crash, Bitcoin might hold steady or even rise, offering a valuable hedge in uncertain time. Why crypto has staying power? There's also a bigger story at play, one that's technological, financial, and even political. Blockchain technology itself is revolutionary. It has a potential to reshape industry from finance to supply chain to social media. Cryptocurrency like Bitcoin challenge the entire concept of fiat money, offering an alternative store of value free from central bank manipulation. Even regulators who once saw crypto as a threat are becoming more open. In fact, President Donald Trump recently announced plans to hold Bitcoin, Ethereum, XRP, Solana, and Cardano as part of the US strategic reserve, essentially treating crypto like a digital gold. Let's talk about historical performance. High risk, high reward. Of course, it is not all smooth sailing. Crypto is known for its extreme volatility. Just look at the Bitcoin history. In 2024, the return was negative 57.5%. In 2018, the return was negative 73.4%. And in 2022, the return was negative 63.4%. But here's the twist. If you look at the longer term, over the full 13 years period from 2012 to 2024, Bitcoin still outperformed traditional markets by more than 10 times. It is a classic case of high risk, high reward, and institution knows even a small allocation could provide outsized return. And it is not just funds. Major corporations like MicroStrategy and Tesla has publicly added Bitcoin to their balance sheet, betting that digital assets will play a long-term role in the global economy. For individual investors like you and me, the same logic applies. Even a small percentage in your portfolio in crypto could enhance return without dramatically increasing risk. If you are starting out, Bitcoin and Ethereum with their large market cap and deep liquidity are the safest bet. Another factor driving institutional interest, Bitcoin's fixed supply. There will only ever be 21 million Bitcoins, and after the latest halving in April 2024, new supply became even scarce. This program's scarcity, combined with growing demand, is a powerful recipe for price appreciation. In contrast, Ethereum doesn't have a hard cap, but it plays a different role, powering decentralized application and DeFi platform. What actually moved the price? It comes down to two main factors: supply. Many cryptos have fixed or predictable issuance schedule known as tokenomics. If a project lacks transparency around this, it is a red flag. And next thing is demand. Long-term demand depends on whether the crypto solves real-world problem, whether it is powering smart contract, enabling decentralized finance, or serving as a hedge against inflation. Of course, regulation also matters. The SEC, Security Exchange Commission's approval of Bitcoin spot ETF in January 2024 and Ethereum spot ETF in July 2024 have sparked a massive wave of institutional buying. This kind of decision can set the tone for future adoption. Crypto isn't without competition. Ethereum faced challenges like Solana and Cardano, all competing to be the go-to platform for smart contract and decentralized app. And risks, there are plenty. First is because high volatility, prices can swing double digits in one day. Security issues, hacks and scams are still happening in the space. Liquidity risks, smaller coins can be hard to sell in the downturn. That's why it is crucial to diversify, use secure wallets, and only invest in what you can afford to lose. So is crypto still just a gamble, or it has become a legitimate asset class for serious investors? Wall Street growing interest suggests that crypto isn't going anywhere, and its role in diversified portfolio will likely keep expanding. Of course, this is not financial advice, and crypto remains high risk. Always do your own due diligence before investing. But one thing for sure, whether you are all in or still on the sideline, the era of institutional crypto is here. Let me know your thought about this. Will you add crypto in your portfolio? Give this video a like and subscribe to our channel for more insight like this. See you in the next one.